Hello and welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at the Australian. Welcome aboard, everybody. Now, one of the things that's been happening, I think, perhaps more recently, that is since the start of the year, all the forecasts for property, as you know, were the consensus was that it would be another good year, at least a forward year, 3 to 5% increase. Really seemed to be the consensus across the board. But there have been some reports and forecasts since that are negative, and there's been some things in the property industry that I think anybody who is in the industry as an investor, particularly, you should at least be aware of, right? There are some distressed sales, for instance, rising in the New South Wales area. That came up in the SQM results yesterday, hot off the press, if you like. But other issues that are bearing down on the ability of people to spend, really. And consumer sentiment, for instance, shows that the willingness to buy a house has dropped quite substantially. That came up in the CBA report a few weeks ago. I wanted to talk to someone who could put that other side to us, and I have the perfect person. It's Stephen Koukoulas. He's an economist with Market Economics, and he joins me on the show today. Hi, Stephen.
Good morning, James.
How are you?
I'm very, very well. Looking forward to having a great discussion about these things and more.
What caught my eye with you was, I think it was probably early January when there wasn't much doing, may I say, in media world. And I saw you had a forecast out that the Australian property market, residential, house price nationally could drop 5% this year.
Yes.
Just tell me, what made you come to that view?
Yeah, the thinking, I've been looking at house prices for many years. Look at my grey hair. It's been one of the things that we love to talk about. And obviously, from a cyclical perspective, the interest rate cycle does matter. But as we saw in 2023, even with the cumulative effect of a whole range of interest rate hikes, 425 basis points in total, house prices nationwide kept going up and up
by 9%,
and up, by a lot.
Yeah.
And so that was something that was driven by supply and demand. You know, Economics 101 is an important thing to stop and think about when we're looking at any aspect of the economy, but including housing. When the borders reopened post-COVID, we had the influx of immigrants, including students.
500,000 people.
A lot of them, and we hadn't built enough houses.
Yeah.
So it was showing up not only in house prices where there's rush to buy, but also in the rental market where rental vacancy rates were at record lows effectively in most capital cities. Rents were increasing by 10, 12, 15% on an annualized basis, and still are, by the way. Yeah. And so we had supply and demand really having an impact. The other thing that was important to me too, and this is one of the reasons, if I can preempt, why I'm, I won't say gloomy, but why I think house prices are due for a mini pullback through the course of this year, is the labour market.
Okay.
In 2023, we had unemployment rates staying incredibly low, 3 point something, which for Australia is stunningly low. We had finally, for the first time in a decade, some wage increases, and even though they're at this stage they appear reasonably well contained, there was a bit of an income effect. I've got a job, so I can afford to borrow money.
Yes.
And so a combination of supply, demand, a solid labour market with rising wages fueled rising house prices.
And what's changed?
What's changed? It's probably a little early to sort of say that the rate of increase in population growth is slowing, but that, what do we call it, that sugar hit from 500,000 people coming into Australia very, very quickly is now easing back. And I don't want to overstate this, but it's coming back to 250 to 275,000 people, approximately that. So that demand surge is less acute. It's still there, don't get me wrong. This is why we're not having a house price crash or anything like that. So that's one important thing. And the labour market's deteriorating.
Okay.
We know from the actual hours worked, household incomes, that there's a weakening occurring in the labour market. And if we believe the job advertisements, job vacancies, that the unemployment rate currently at 3.9%, which is still very, very good, by the way, will rise to, well, I think Treasury is forecasting 4.5%. The RBA, well, we'll get a bit of an update shortly, but probably 4.5%. So not catastrophic.
Yes.
But it's very hard to get a loan when you're unemployed.
Yeah.
And or whether you want one when you're at the risk of working for your hours.
Can I ask you about the unemployment rate? And I know traditionally we were all told as the unemployment rate rises, the housing market softens. It's very simple. It's the thing that matters most of all for all the sort of noise and sickness. This is the one that really matters. If you're unemployed, you're in trouble with your mortgage. That doesn't happen with other things. Now, hours worked. Does that matter more than it used to?
It does, and that's
the
a
gig economy
fantastic
and
point.
everything. Yeah,
And in fact,
yeah,
just in the last, well, approximately 6 months of 2023, we had this interesting phenomenon that until we got the December monthly data, although they're very choppy around year end and start of the new calendar year. But through the course of the second half of 2023, we did have employment being reasonably solid still, but the number of hours worked per person was falling. And of course, the fewer hours that you work,
yeah.
the less your boss is
The
going to pay
the
you.
less you're going to have. Yeah.
So if you're working 35 hours a week, you get X dollars. If you're only working 30 hours a week because, we don't need you to come in tomorrow or these sorts of things, your take-home pay actually goes down. And then when you apply to a bank loan, they say, well, hang on, you're not earning quite as much as we thought, so we will only lend you a certain amount, and that feeds into this housing cycle. So early stages of that impacting, but if that trend continues, which I think it will, as the economy remains reasonably weak in the first half of this year,
Right.
it'll have a bigger impact on house prices as well.
Okay, and just to go a little bit deeper there, then, why do you think that issue of people working less hours or being offered less hours, why will that continue this year or expand this year?
Well, certainly the first half of 2024 is going to be weak for the economy. We know we don't have a lot of indicators for 2024 yet, but the way that 2023 finished for things like retail sales, building approvals, sort of what do we call it, the nuts and bolts of the economy, if you like, they were weak.
They were very weak. Retail sales were very weak.
Particularly we had a bit of a spike with the Black Friday sales in November, and then a big fall in the month of December. So if that trend continues on into the new year, then we're going to have a weak economy. And as I touched on, the sort of job advertisements, job vacancies series, well, they're not in free fall. Again, I don't think we're having a recession. I don't think we're going to be that bad, but it's just going to be this sluggishness in the economy. We don't need as many people.
Along. Yeah.
Yes.
Yeah. Okay. Now let's people listen all around the country, and all property is local. There's considerable variations in that. So before we get into just a little bit deeper into your forecast, that's a nationwide forecast. Now, in the property market, the strongest market is WA just now. The weakest market is probably Victoria.
Yes.
Does the national economy reflect that at all, or are they going their separate ways?
It's an excellent point. There's always a difference between property markets, whether you're in Perth, Brisbane, Wagga Wagga, Ballarat, or Hobart.
Yeah.
There's not one property market. However, I look at the state and capital cities numbers as well as the national figure. But of course, the Reserve Bank doesn't set a different interest rate for Perth as opposed to Melbourne, because they're experiencing different economic fundamentals.
That's an important thing, isn't it?
So they only set the cash rate for Australia on the national data. While they might have said, "Oh, gee, Perth's a bit strong." If Perth was our only economy that we were looking at, we wouldn't cut rates.
Yeah.
If I don't know who the weakest is now, probably Victoria, was the only economy we looked at, we'd probably cut rates now.
Yes.
But alas, they look at the whole economy.
Yeah.
But your point is quite correct. And this comes back to the supply and demand issues and the relative strength of each of the state economies. WA is doing exceptionally well. So even though the global economy is a little weaker, the commodity boom is still strong. Iron ore is still $125, $130 US a ton.
Yeah.
It's down a little bit, but boy, oh boy, it's a long way away from the budget estimates of $55 or $60 a ton.
It's double what they thought it would be.
Correct.
Yeah.
So the fly-in is having people fly in. And remember that WA had its borders shut to the rest of Australia. And as soon as they were lifted, that people went home in inverted commas, to WA. So they've had really strong population growth and a very poor level of building construction activity.
Right.
So they've got the dynamism of the mining sector doing well. So it's not just people driving the trucks and digging the iron ore and other things out of the ground. It's the people who support them in the legal industry, the banking industry, the finance
services
industry.
around that,
all of the bits and bobs that go with that. So WA is doing really well, and that's feeding into Perth prices going really, really strongly.
So we could have, just even developing that, you could have a situation where the Perth economy is flying and the prices are flying, and the RBA cuts rates into that, which they would never do if there was a Reserve Bank of WA.
Yes.
Yeah, okay.
And in fact, think back, I remember quite well in that period from approximately, I don't have the dates in front of me, but approximately 2003 to 2008, 9-ish.
Okay.
Mining boom Mark I think it was called, when we were all policymakers, mining companies were caught flat-footed by that incredible lift in demand for iron ore in particular, but energy also from China when they had that incredible growth spurt. We had mining investment quadrupling
Yeah.
Almost all of it was in WA.
Yeah.
And the Reserve Bank was cutting interest rates in 2009-10 with the global financial crisis. WA had an unemployment rate of 2-point-something%.
And the RBA were
Unbelievable.
inadvertently fueling that hot economy.
Because the eastern states were under trouble because that's
yeah.
generalising a little here, but that's where the banking and finance sectors are predominant, and the economy were weaker over here.
Yeah.
And they were saying inflation was incredibly low nationwide,
Mm.
so they trimmed interest rates.
So when you think about a nationwide drop of 5% in prices that you'd forecast in January, that's a national forecast. So that would suggest to me, that Melbourne really could be very weak. If Melbourne's the weakest,
Yes,
and then it would seem to me a red flag for Victorian house prices.
Indeed. In fact, I would say that, and in fact, it's already showing up in the high-frequency CoreLogic. They have a daily house price series, goodness me. But it's based on daily settlements in the property market. So when people say, daily house prices, my house doesn't change in price today or tomorrow. Yeah. But it's based on hard data that the local government and state governments have on their transactions. However, it's already showing that Melbourne prices are down only a little bit, about 1% from the peak late last year. So they're starting to soften.
Okay.
Sydney, which had been really solid in 2023, it's flatlining, and there's well over half of the housing market. So if we think about that minus 5% forecast, it implies Melbourne, Victoria more generally, probably has a minus 7, 8 or 9%.
Yeah.
Sydney's probably the minus 3, 4 or 5.
If it was annualized.
By year end. On year on year,
Okay.
by the time we get to December 2024.
Right.
And that, we know Canberra, this is a relatively small economy, and Hobart they're basically flat lining. Some of the regional areas are weaker because we have people sort of might have bought that little holiday house when we're in COVID and now they don't want it. I think Perth will still do well because I think that's the resilience, and Adelaide's very strong in Brisbane. There's demographics, that demand for property. People go up to the lovely warm climates in southeast Queensland. They probably are a bit more resilient, but they will still not grow as fast.
Okay.
So you put that all into your 8 cities spreadsheet, and a number of about minus 5 pops out the bottom.
Interesting. Okay. Now, the other, which is very useful for an economist to when we're talking to you and as with a property investor hat on, is about inflation. I've made the point a few times. Hey, folks, if inflation's 5 and prices rise by 5, you're not winning. You're treading water. So tell us about inflation and where it is. What happened last year? Where are we now? And what's the forecast for the year ahead?
I'll start at the end of 2022, actually, if I may, because that was the peak inflation rate in annual terms. If we looked at the quarterly data, it peaked at 7.8%. Goodness, that was dreadful.
It's getting scary.
It was very scary.
Yeah, absolutely.
And that's why the RBA was hiking interest rates. Mm-hmm. It's pretty simple.
Yeah.
But through the course of 2023, through a combination of the softer economy, the economy did weaken. Some of those supply chain issues that impacted prices, for example, international shipping rates, car prices, these sorts of things were fixed, if you like, because we had a decent lift in global production of all of those goods in particular.
Yeah.
And so by the time we got to the end of 2023, on the quarterly data, inflation was down to 4.1%.
Yes.
And if you look at just the December quarter in isolation, and I don't want people to get carried away about one quarter of data. They can be quirks. They can be noisy indicators. However, I do note that the December quarter increase was only 0.6%.
Yeah, right.
And so there's some bigger 1.4 type numbers dropping out of that run rate. So when we get the next quarter, the March quarter 2024, the March quarter 2023 number is 1.4%. If that's replaced with another 0.6, you're getting 0.8 percentage points off your annual CPI. So we'll be down to 3.3, and the trajectory will be towards the RBA target range. So
right, which is 2 to 3.
Between 2 and 3%.
Okay.
And they're pinpointing 2.5 with this new methodology that Jim Chalmers implemented for the RBA.
For the RBA. I know there's a new methodology for the RBA in communication, but from the property investor point of view, that's kind of, it's interesting, but it's academic to some degree. What they want to know if you're an investor is, what can I expect on rates? What can I expect on inflation? What can I expect on prices? On inflation, in the early days of the inflation pop, a lot of it came from the building industry, didn't it?
Oh, indeed,
and
yes.
People are, one of the things that's come up on the show, I thought was really interesting, was that if there's bargains out there across the nation, it's in what we used to call fixer-uppers. because people are afraid to get involved in renovation because they're concerned of the labor shortages in tradies
Yep.
and that the inflation was at its worst in the building industry in terms of building materials and all that. Like, was that right? And is that
Yes.
still the case?
It was certainly the case. And that was some of these supply chain problems that lumber was scarce and very, very expensive. I remember talking to folk at the Steel Association about 18 months ago. Steel beams, which are, the basic building block for many residential properties, were hard to get and expensive too.
Yeah.
Because of the supply chain problems, the freight shipping costs, we import a lot of that stuff.
Yeah.
And so they became very, very expensive. And you touched on too that the unemployment rate of 3.5% or thereabouts is good news for an economy, but it means there are labour shortages, particularly for the tradies, the plumbers and the bricklayers and the carpenters and whatnot that make a house. So not only were the timber and the window frames and the beams and all this other stuff that makes a house expensive and scarce, which meant it took longer to build too, which of course time is money. So it was expensive. But the labour costs were very high.
Yeah.
Now, you asked, has it changed? The short answer is yes. There's a lovely chart that I think will probably be on the RBA webpage. I'll have to come back to you on where it is, that shows building costs for both residential and non-residential construction, because of course there's some substitutability between the two. And prior to the COVID pandemic, it was bouncing along. Sometimes it was about -1, sometimes it was +5, depending on a lot more volatile on consumer prices.
Yeah.
Shot up to 20%.
I see.
Massive increase. That's now down to back to about +3 or 4%. So much more normal. Doesn't mean the prices are falling. So that lift in prices that we saw has been locked in, but the rate of increase has come back down.
And does it imply then that if you are a property investor and you're considering renovating or using the building industry in any fashion, that it's somewhat returned to normal?
We're getting back to normal. And the fact that the unemployment rate is edging up means that there'll be an extra supply of workers available to renovate your kitchen and bathroom and put on the extension and do your fixer-uppering.
Yes, fixer-uppering. Which, by the way, folks, the point I was making there is that we had more than one person on saying that is actually, in terms of looking for value, that there is real value in that area because of that factor that people were afraid to do it. I mean, there's always a number of people who just can't face it anyway. But people who even were eager to do it were worried about how long it would take and how much would it really cost. And I know people in building, in residential home building, and they were worried because they couldn't accurately price what it was going to cost to build a house, and they were being caught to the point that they were making no money at all on developments.
Oh, indeed, James, if I can just butt in there for a moment. We saw through the last 12 months small and medium building companies going bust. There were many of them because they offered to build a property or renovate a property with a fixed price contract. Then they ordered the timber and the steel, tried to hire the tradie to make a house and renovate the house, and they just got burnt and they went bust. And that's part of the problem. It's actually limiting supply of new properties, just by the way.
Of course, of course. But is there any economic measure for how long it takes to build a house? It seems to me, as I look around my neighborhood or any neighborhood, I'm looking at apartment developments in the city of Melbourne, and I'm saying to myself, I remember passing these during COVID with a mask on, and they're still in there. Is there any evidence that buildings took longer to build than they used to?
There is. There's and it's it's an implied number, but it is true when you think about it. There are building approvals numbers. So here's an approval to build 10,000 dwellings, for example. And then there's the completion rates.
Yes.
That the dwelling has been completed and ready for someone to rent or buy, move into, in other words. What's happening, of course, is building approvals have been weak, but completions, and we shouldn't forget that one of the stimulus measures during the pandemic was the home builders bonus.
Oh, yes, of course.
And we did have a big lift in construction, and I think that was one of the industries that was allowed to keep functioning because people were outside and all this. And we did have a big construction lift in 21-22 financial year. So that was really important. But I think the key point that's come of that is that the completions are still lagging the building approvals. Normally, a building approval happens and the completion, if you look at a lovely chart on this, lags by about a year.
Okay, a year.
Now we've got building approvals leading and dwelling completions lagging. It appears from my eyeball econometrics about 18 months.
Yeah, right. And that's
so it does appear to be slow. So we're not having as many completed houses, which we need with this population growth. But one of the government's been banging on about we need supply, we need supply, we need supply. Yes, that is one of the issues to deal with housing affordability. But we've got this tardiness, I suppose, between the building being approved. Yep, I've got the approval. I'm ready to build that apartment block, the townhouses, or my own individual freestanding dwelling. Yeah. And it being completed, ready for me to move in.
Yes, yeah, it's really interesting. I've wondered about that.
It's true, but it's true. Yes,
yeah, just observation. Gosh, that tower seems to be taking forever. Yeah, okay, very interesting. What we'll do, folks, is we'll take a short break. That was Stephen Kukulis. We'll be back in one moment. Hello and welcome back to the Australians Money Puzzle podcast. I'm James Kirby, the wealth editor at the Australian, and I'm talking to Stephen Kukulis, well-known independent economist. Market economics, that's the name of my business, Market Economics. Yes, Stephen Kukulis, the Cook, as he is often known, K-O-U-K. All right, now, a question from Carlos.
Yes.
I appreciate your views on the debate about property versus shares. I was talking last week about, I think it was on this show, that we were talking about big difference with shares and property was that there's a certain powerlessness as an investor in shares. There's the shares, they go up or down, you can't do a damn thing about it. If you own a property, an investment property, you can actually get up in the morning and say, I'm going to make it better. I'm going to improve it. I've got the gears, I've got the lever, I've got the wherewithal to make this a better property than it used to be. So Carlos takes that point. He says, I agree. The question is, in comparing asset classes, I think property takes median values. However, does this take into account the capital improvements homeowners or investors have made? Does that
it does in the final selling price? Yes. So, for example, buying the proverbial fixer-upper that we were talking about a moment ago, you might spend, I'll just use a round number for argument's sake, $100,000 painting it, putting in a decent kitchen, putting in a few trees in the little courtyard so you've got some nice outside area. That house is going to be worth more than before it was fixed up. So that improvement does show up. And for an owner-occupier as opposed to an investor, that's tax-free money, just by the way, because you don't pay capital gain tax on your home. But for the investors, you'll get the tax deduction of the repair costs, but your property will be more, well, it'll probably rent for more because it'll be more desirable for someone to live in a house that's got a new kitchen and whatnot. And so you actually do yield a return from having a better property that you've enhanced through repairs, renovations, and even the outside garden.
I might, there's something I must add to you. This is just out of left field. Question without notice.
Yes.
You live in Canberra?
I used to live in Canberra. I used to live in Canberra for many a long day, yes.
Tell me one thing. It's come up on the show a few times about rent and what to do about it.
Yes.
And Canberra has this rent.
You're going to ask about that land tax type concept that the ACT government put in place.
No, I wanted to talk about the fact that Canberra is the only city in Australia that has experimented in some serious way with rent caps and rent freezes.
Yes, that as well.
Was it good or bad for the market?
In terms of the availability of property, it didn't work.
Okay.
There's a shortage. Again, it's hard to differentiate that policy change with the underlying fundamentals of the housing market because there's a housing rental shortage throughout the whole country. Yep. Canberra, it's the same, but that capping of rents, while it might be superficially appealing that, we're looking after the poor renters, and I have a smidge of sympathy for that view.
Yeah.
It hasn't really worked because landlords have been put off. If I'm buying a property for X dollars and I can only get this much rent, the maths doesn't work, so I'm not going to buy it. So the supply of rental properties comes down.
And is that reflected in Canberra?
It is, yes.
Okay.
So Canberra actually at the moment, again, my lovely database from CoreLogic, who provide the terrific house price data, just by the way, and rental data, Canberra is one of the cities right now, if you go onto their webpage, you'll see that rents in Canberra are going backwards.
Yeah, right.
They're falling. Not just going up at a smaller rate. They're actually dropping in Canberra.
Why do you think they're dropping?
I think one of the reasons is, yes, because there's the whole scene for investors just is very, very weak.
Right. Of course, there's people who say, hooray.
Well, some people would say
Renters
hooray.
would say hooray.
So, yep.
Yeah, of course.
It's
But,
great for them. Yes, indeed.
Okay,
Yep.
interesting. So it has. So that particular policy would.
Well, maybe it is working.
Well, it would seem to be influential on the.
It does influence. My concern will be on the next upswing.
Mm-hmm.
That will we get that supply of rental property remaining there, and do we get a real squeeze in the rental market going forward?
Yeah, because people
on a downswing it's fine, but on an upswing
the investor says don't bother.
Correct.
Yeah, go somewhere else. Okay, all right. Question from Swi, TSWI, pronounced Swi. I'm informed by the listener. Okay, long-time listener, first-time question. My super is with, and he mentions the fund, and I'll assume it's Aware Super, which is one of the big industry funds. They recently introduced the Indexed High Growth Fund as an option. I'm 42. By the way, folks, this is never advice, it's only information. Due to my age, I've had my super in the high growth for some time. And when it became available, I switched to Indexed High Growth. However, I'm now starting to wonder if this switch was such a good idea, as the indexed option does not include investments in private equity. Okay, Sweet. When I talked about private equity on the show last week, the point I was making was that there's constant fashions, if you like, in finance and investing, and there's always something that's on the run. And Will Hamilton, the advisor who was on the show, made the point, there was a time where hedge funds were new and everyone said, God, you got to get in there, and you're silly if you're not in there. Private equity is going through that sort of thing at the moment. And I'm not that I'm skeptical about it. I'm skeptical about everything, but I'm skeptical about the method in which it's been sold to you, the everyday investor, because chances are you can't actually put 10 million into something. You can probably put 1,000 into something or 10,000, and that means you're probably not going to buy a listed fund. And I think that's kind of upside down, because private equity, the whole thing is it's supposed to be private, not listed, but your way into it is listed. And that's what I'm skeptical about. So look, my gut feeling, Sweet, is I wouldn't worry about that. I wouldn't worry if my super fund didn't obviously have private equity. That's my gut feeling.
I wouldn't worry about it either. Investing, particularly your superannuation money, is such a, it's a personal thing. There's a life cycle component to it. The younger you are, take on lots of risk. As you approach retirement or you're in retirement, be a bit more conservative, because you can't ride out these buffers. We all hopefully know about that. But also on asset classes is a very difficult thing to work out too. And a little bit like the crypto stuff of the last few years. Because I missed the boat and I didn't buy Bitcoin at $100 or $200 or $1,000 or $5,000, and it's now $40,000 US. I don't regret that at all as an example, or I don't regret missing out on some private equity. I am comfortable with my asset allocation choices in my super fund. I tick the right boxes. I monitor it semi-frequently to see how each component's going.
Is this an SMSF?
It is, yes, it is. And I monitor it.
Yeah.
And I think, if only I'd bought Bitcoin at some ridiculously low level, or Fortescue Minerals at 10 cents, all those years ago. But then I look at the lithium market right now.
I'm glad
goodness
I'm not in there.
me! I'm glad I'm indeed. You bet. Again, it's horses for courses. It depends.
Yeah.
So it's not just your risk appetite. That's what everyone says. Are you happy to take risk and maybe make a mozza, but also lose a mozza if things go the wrong way for you? So that's fine. That's each person's appetite. But if you want to be just relatively untroubled by your fund, so that's where some of that approach, and this fellow's only 42. You've got plenty of years to go before your retirement. The high growth, high yielding stuff, give it a go. Yes, there'll be swings and roundabouts. There'll be times when it takes a bit of a hit, but when it goes up, it'll go up nicely, and you'll yield
I wouldn't worry about
private equity.
What they don't have, or what
you can't invest in everything, I think, is the other thing that we learn.
Exactly. You can't invest in everything, and you are in a growth. You are in a growth option as it is, which would seem to be about growth. The younger you are, the more you to be exposed to growth, and
indeed, yes,
it cools
that's
off
what I tell my children.
Older.
So they tick the high growth box.
they can buy those. They can buy those speculative shares. All right, we'll take a short break. Back in a moment. Hello, welcome back to the Australian's Money Puzzle podcast. James Kirby, the wealth editor of the Australian, with Stephen Koukoulas, market economics economist, and we have talked about property today in terms of forecast. Stephen actually holds to a 5% decline in nationwide house prices in 2024, and I think, looking back at some of the things he has been saying, it's worth keeping those things in mind. Unemployment particularly going the wrong way. Hours worked, more importantly, I think, going the wrong way of late. Some stress signals in the economy. But I think perhaps the main thing, tell me if I'm wrong, but the main thing is that whole escalation, if you like, of interest rates, the cumulative impact of interest rates isn't finished of the rise.
Well, the last rise was only in November.
Yeah. And
So it wasn't that long ago that
Yeah,
the RBA in their wisdom hiked interest rates. And before that was June. And there was a series in the first, I think there were 4 rate hikes between February and June 2023. Here we are in February 2024.
Yeah.
And we know from a ton of economic literature that the effect of interest rate changes, both up and down, is long and variable. That's the shorthand way of saying that the impact on cash flows, on sentiment, on the animal spirits, if you like, usually takes between 6 and 18 months, I think is the way that it's described. And so the very first rate hike, gosh, going back almost 2 years from 0.1 to 0.35, it's probably had its effect because it's coming from such a ridiculously low level. The effect's probably nothing. Yeah. But as you said, the cumulative, then the next one, then the next one, then the next one. We've had 425 points of rate hikes now. So that cumulative effect, as well as the most recent effects, the ones through 2023, are yet to fully impact on the hard data in the economy and the actual performance of the economy. And even when it comes to housing, it's actually quite a curious thing. I remember, I can't remember who did this survey. It may well have been Ilian some time ago. Did some work on what consumers would sacrifice in terms of their repayments first in periods of economic and financial stress. Yeah. The mortgage was one of the last things. They'd give up paying their phone bill or their Netflix or whatever. Yeah. Their utilities bills were there, but they would, it was overwhelming that the mortgage was the thing they would pay. And again, when you think about the cumulative effect of rate hikes, there's a rate hike, you swear and curse, but you'll make the repayment. Yeah. A point may come after you've run down your savings, after you think, well, gee, our mortgage is just too big, or that last couple of rate hikes are the ones that broke the proverbial camel's back. That's it. I'm done. I'm going to have to sell my house. Yes. So that's the cumulative effect and the lagged effect. There's a few months that we're all fine. There's a lag. Yes.
Could you just cover one last thing? We mentioned briefly about the distress sales in New South Wales.
Yes.
What's happening there?
Yeah, SQM, who do wonderful housing research and database. Look, I think New South Wales, which in Sydney has the highest house prices in Australia and some of the highest in the world, I think there is genuinely a sticker shock effect starting to happen now. That some folk who may have, it may even be a mini mortgage cliff effect. I'm not a huge fan of the mortgage cliff because it was very well telegraphed, and everyone who had lucky enough to have one of those mortgages knew that they were going to be rolling over into much higher interest rate. But Sydney-siders have the highest level of debt. They've got the highest house prices, and the fact that we've got this economic slowdown occurring, the rollover of mortgages still occurring. Most of them have happened, but we've still got a few.
But their mortgages are going to be relatively bigger than everyone else's.
They're going to be massive, and they're going from a 2.25% mortgage to 6%, let's say, for argument's sake, which is probably happening on $1 million mortgage. That is genuinely financial stress. So, and again, put in inverted commas, the lucky thing right now for both the homeowner and the banks, critically, is that house prices have gone up. So if there is a forced sale, if there is this distress selling, as SQM are talking about, at least the homeowner will get their money back, their deposit, and the bank will get their money. So there's no provisioning for
negative equity.
Yes, there's no just yet. And as we mentioned before, Sydney's house prices are just topping out. Yeah. So watch this space, as they say, because that's one of the things that's very, very hard to forecast.
Okay, that's very interesting. It's a regional issue, just yet. It's in Sydney, but interesting. Sydney tends to set the trends. All right. Now, final question. Actually, it's a comment. It's from Scott. In the previous episode, you discussed. Oh, sorry. Apologies, folks. That's the wrong one. I can't find the question. In any event, the last question was a listener who wanted to say that they really enjoyed the collectors episode, particularly the one on whiskey, over the summer. And I'm delighted to get that because I was wondering, did you like it? We had, if you recall, over the summer break, we had collecting whiskey, collecting rare books, collecting wine, collecting cars, and collecting art. And I'm taking that as a consensus that you all liked it because I certainly liked it. I didn't do racehorses. You know what? I didn't do racehorses. I couldn't find someone. I asked Lindsay Maxted because I used to know him. He and
Yes.
he wouldn't come to the party on it. I asked a few other people and I gave up. And I forgot that you are a racehorse man. So the next time we do collectors, we will do how to not lose an awful lot of money when you're collecting racehorses.
Having said that, I've got one thing to say, and I'll be brief. Owning a 5% share in a racehorse that might be trained by someone like Kieran Maher or
Yep.
Gay Waterhouse and Adrian Bott is about the same cost as owning a cat or a dog.
Oh, yeah.
I've done the numbers on that, so I look forward to chatting about that one day. Yes, it's expensive. You don't do it to make money. That's all I can say.
Right. Well, I suppose the potential upside is the very expensive dogs that are around these days.
Yes.
You just have them, but if your horse just might win a race somewhere. That's for another day. That was Stephen Koukoulas, folks. Great to talk to you, Stephen. Thanks for being on the show.
Thank you, James. That was great fun. Thank you.
And thank you, everybody. Remember the email, themoneypuzzle@theaustralian.com.au. Do send in the questions, comments, observations, anything at all. And if you thought those collector shows was a waste of time, let me know that too. I want to know what you want. All right. Talk to you soon.